Good morning, ladies and gentlemen. Thank you for joining us this morning for the December investor webinar of Cypherpunk Holdings. I would like to welcome all of our existing, but also potential shareholders. My name is Veronica Oswald. I'm the Director of Investor Relations at the company. And I am, of course, joined by our CEO, Jeff Gao, who will give you an update on our developments since the last call in November. I would also like to add that this webinar is being recorded and you are encouraged to submit questions via the Q&A box, and we will take these questions at the end of the session. Thank you very much, and over to you, Jeff.
Thanks, Veronica. Welcome everyone to Cypherpunk Holdings December 2021 monthly investor call. I would like to thank everyone in the audience for making the time to join Veronica and I. For those who cannot make it, all sessions will be recorded and uploaded to our website and our socials. A Q&A session will follow the presentation. Audience questions can be entered into the chat at any point in time. Before we begin, I would like to make all attendees aware that standard disclaimer rules apply, and any forward-looking information are based on the management's beliefs, estimates, and opinions. This presentation is intended for accredited investors and financial institutions. The way we see it, there is no point in buying HODL stock if all we're doing is holding on to asset coins. Retail investors can do that in their own wallet or trading account. Our value and our reason to exist is justified by our ability to execute strategies that beat the underlying index. Over the coming 12 months, investors may notice that the quantity of Bitcoins in our treasury fluctuate, despite the fact that there may be no change to our balance sheet, or perhaps even there would be an increase in our balance sheet. This represents an effort to increasingly push our treasury out to bespoke hedge funds to generate excess returns through arbitrage and other hedging strategies. These funds have survived an extensive due diligence process and vetting process that began all the way back in June. Cypherpunk has secured preferential terms in performance fees in exchange for our collaboration on various fronts. This gives us a direct line to their founders, while also allowing us to perform continuous due diligence on the product. The historical risk-adjusted returns on these products have been nothing short of phenomenal. These funds typically generate a solid 20 to 30% APY, with less than 20% of trades closing in the red. And that's just the median point on the performance spectrum. The funds are not without risk, but those risks are being continuously monitored and taken into account in our asset allocation. The funds we have paired with have established track records, and their numbers reflect their skill at identifying asymmetric opportunities and setting up positions where they have confidence and visibility over the execution chain end to end. That execution chain begins with trade identification, position setup, all the way through to unrolling and taking profit. To that end, Cypherpunk seeks to replicate similar odds on our deals front. We are currently evaluating and onboarding projects that have both substance and momentum. The projects we're targeting are those that can really move over a 12, 24, or even 36-month timeframe. And we have some degree of influence over this. What do I mean by influence? Well, when we onboard these partners at their seed round, we are already thinking about and working toward their Series A. The teams behind these projects use Cypherpunk as advisors in developing their product, their distribution channels, and providing assistance with future fundraising on the condition they meet the agreed minimum milestones. Now, any windfall that comes from liquidity events, whether it be in relation to our investment in hedge fund products or in bespoke private equity deals, that would go back toward building our treasury. And so that means Bitcoin primacy, and then to a lesser extent, looking at Ethereum and perhaps other tokens as well. But first and foremost, Bitcoin. So all of this accumulates toward that end goal, which is the accumulation of our treasury, focusing primarily on Bitcoin. One of the most challenging aspects of being a private equity investor is being able to adopt and adapt to new frames of reference, to move beyond one's comfort zone and start using the right telemetry, data, and coordinate systems to accurately measure and map the disruptive impact of projects emerging from the cusp of human creativity and ingenuity. We do not want to become a Kodak who dismissed the threat of digital cameras by comparing them with Polaroids and allowing their assumptions to build into an existential crisis. Neither do we want to be like Nokia, who saw the iPhone's touchscreen keypad as just a digital version of a physical keyboard, while completely ignoring Apple's, at the time, revolutionary and ingenious use of hand gestures as a device input source. Our vision is to embrace a new way of thinking about and assessing the ideas coming through our private equity deal flow, to find those ideas that can foster new patterns of social interaction in how we work, rest, and play, and then work with the founders to execute on those milestones. We are not a passive money manager, and we do not simply allocate funds to projects in a fire and forget fashion. We work with founders as advisors because it is in our interest to see them succeed, and our hands-on involvement allows HODL to influence each project's probability of success. Fundamentally, how we undertake due diligence to find and validate value has remained largely the same. What we have introduced as an addendum is where we look for value and how we engage projects we onboard. To that end, our activities will be governed by 5 core pillars. Rather than talk about these pillars on a theoretical basis, I will instead touch on some of the conversations I've been having with project founders, many of whom are collaborating with us to complete technical and financial audits as part of our due diligence process. So for the time being, please forgive me if I can't talk about these projects in any great detail, not at this stage, not until those formal announcements are made to market, but at least I can speak about the design and investment principles that we have onboarded to try and identify and build that substance with these projects and their teams. So we have projects in our research and due diligence pipeline that seek to rewrite the rules of the road. These include decentralized autonomous organizations, or DAOs, and governance token protocols that influence how rewards are distributed among stakeholders. Naturally, these programmable social contracts are a threat to the establishment because their design and operation outcompetes present-day tax systems, for example. We have also identified projects that securitize tokens against measures of energy, as well as projects developing blockchains linked to useful work, which are variations on the proof of work consensus mechanism we're all familiar with in the case of Bitcoin. And these represent innovations on top of the basic layer 1 Bitcoin blockchain. These conversations have been very insightful in that most of the news around crypto innovation have been focused on Ethereum blockchain layer 2. So it was refreshing for me to speak with visionary founders and project teams working on ideas within the Bitcoin proof of work ecology. These projects are all working on their own individual value propositions to add to the Bitcoin blockchain ecosystem. But they all share at least one thing in common, and that is they present strong use cases that can be traced to sources of strong demand and willingness to pay. And that would ultimately translate to a nearer term liquidity event than would otherwise happen. The key players behind these projects are all visionaries who seek to create equitable and meritocratic standards that challenge accepted norms and practices. Both Cypherpunk and these teams, on that basis, understand the risks involved in upsetting the apple cart, but we're also managing these risks. Although shareholders need to be aware that these risks will always exist in moderation, unless we decide to exit the business of innovation. So to summarize HODL's reasons for its existence, we add downside protection and yield diversification features to our crypto treasury. This is an area where we have overmatch relative to competitors because we will be working closely with a range of hedge funds to execute this line of effort. But we do advise patience and caution because the process of learning how these partners operate is non-linear, and it also takes time to deploy hundreds of Bitcoins and Ethereum in a secure and responsible manner. We're small, we're lean, and as such, we have both first mover and fast mover advantage. In fact, with one project, which we have yet to announce, we're co-lead investors with one other organization who is arguably one of the biggest names within the crypto, NFT, and gaming sector. The project co-founder has expressed a strong willingness to work with Cypherpunk owing to, one, how quickly we're able to execute on the deal, and two, the founders have a direct line to my office and I have to theirs. Despite only having just closed their seed round, our conversations are already moving on to Series A. Now, when someone tells you that they're entering the metaverse, your first impulsive reaction should be treat everything that they say from that point onward with the utmost of circumspection. For example, do they understand the metaverse? Do they even know what it is? Do they have projects lined up? Or are they simply making an announcement because it's the hot ticket item right now and there's pressure internally to put out a statement? On the first question, over the next several slides, I'm going to cover with some degree of detail how HODL intends to engage projects and opportunities within the space. The audience can then make up their own mind as to whether they trust that judgment. And on that second question, again, we cannot reveal anything explicitly until formal announcements are made. But there has been plenty of material written, published on our website and across our socials that at the very least indicates some of the principles that we've been utilizing in terms of how we discover and how we work with these projects. At its simplest, the metaverse is a functional and aesthetic extension of the physical world. In the same way, metadata enriches and extends the context of data. When you make a payment with your phone, the amount, the method of payment, they're reflected on the receipt, but the operating system of your machine, the browser version on your phone, those data points are not explicit, but it's in the metadata pack embedded beneath the data layer. And just like how metadata enriches the meaning of data, the functional layers of the metaverse bleeds into the physical domain and helps to enrich people's lives. In dealing with centralized finance, whether it's a traditional bank or a non-blockchain payment rail, the rules governing interactions within that closed system is written for us, the users. In those ecosystems, the roles of content creator and content consumer are fixed and prescribed by a central authority or actor, who's almost always not us. In DeFi, anyone with the courage and the will to learn Solidity or Viper or Python can literally start writing their own social contracts on layer 2. Whether people will take advantage of those opportunities is a different matter altogether. But the key point is people can vote with their participation should they choose to. And if you're not happy with a service in DeFi, you can literally rewrite your own rules. There is no permission to get a license or be registered. Your knowledge is your license to create. Think about what kind of paradigm, what kind of change that this paradigm does to the velocity and the acceleration of disruption and innovation. The beauty of this system is people who fail to understand DeFi for what it truly is will simply look at things like Bitcoin and Ethereum and HODL it. And to an extent, that's okay. That works. And it works so far because people in these ecosystems vote with their participation. And participation is clearly growing, both from a speculative point of view, as well as from a functional point of view. And so when participation grows, so too the asset tokens. They grow as a function of that participation. But we also know that with innovation, it's chaotic and it's messy. And we call it creative destruction for a reason. By virtue of its decentralized nature, this ecosystem is self-organizing in ways that are completely unpredictable. And that messiness translates in one way or another into volatility, which as asset token hodlers, we all know too well. HODL's vision is to stay on the edge of that innovation curve and be focused on where value through participation will grow in that next cycle of a churn. You're going to see this diagram again in future presentations. It representing part my understanding of an evolving conversation between HODL and a number of project founders we're currently working with. We can't reveal at this stage the identity of these partners or what these projects are. So I won't comment on the specifics of what this diagram alludes to, at least not at this point in time. But putting it here at least gives members of the audience some indication of the direction and the curvature of our thinking about the kind of ideas we want to onboard and that we want to work with. And I refer to these ideas and not simply as investments because in addition to providing capital, we are also working closely with these projects as partners. We allocate then our time, our expertise to elevate their probability of success. And that benefits everybody. When HODL invests in the metaverse, we find ideas and people who we can work with to create products with positive economics. So just like how metamorphosis is a process that abruptly and radically changes the state of an object, for example, a caterpillar turning into a butterfly, the metaverse is a radical transformation and social re-engineering project that will redefine the way we work, rest, and play. And there has to be value in that. There has to be a center of willingness to pay in these emerging types of products and services. What's shown on this slide here, again, needs some explaining, and we will be able to get to that in a future call. But at least those present in the audience will have an opportunity to take it into consideration. An invaluable skill that an engineering and physics background gives you is the ability to model dynamical systems whose expected behavior is baked into a set of assumptions and prior assertions. And what do we know has an abundance of assertions and assumptions? It's pitch decks and it's financial projections, the kind of stuff that you get when you work in the space of private equity, when you're trying to evaluate projects. So one thing that HODL excels at, without question, is our ability to separate the red line from the blue line on this page. The only risk that remains on the table is execution. This is where the hands-on collaboration I mentioned earlier becomes paramount. We work closely with any and all projects we onboard, not because we have a surplus of time on our hands, in fact, quite the opposite, but because it gives us that all-important control lever over execution risk. So we do it out of necessity. So to summarize, when HODL enters the metaverse, we do so in a manner that is uncompromisingly rigorous in our research, due diligence, and engagement process. It's all about finding projects, creating services where there will be sustainable demand. I say will be because these types of services are still very much in a proof of concept phase. And there just isn't enough data to confirm nor deny viability. Take the play to earn sector, for example. If players are solely motivated by the monetary rewards in exchange for their participation, then where are the centers of willingness to pay that feeds these centers of willingness to play? If the answer to that question is other players, then we do not invest. If we cannot create testable hypotheses and develop workable proofs of concept for a project, we do not invest. This is how we approach the metaverse, both cautiously and opportunistically. So again, when a company announces all of a sudden that they're entering crypto mining, investors once again should be circumspect and approach with caution. For example, why is Cypherpunk entering mining now? Are we doing it because we just simply ran out of other ideas? Is it just a narrative to try and increase the share price? Or is there something more strategic involved? Now, as everyone who reads our press releases know, we made a seed investment of 300,000 USD in Mining Store. And that operation, that investment became operational in November. Members of the audience can review the numbers on this page in their own time. And all the calculations are derived from that screenshot in the lower right-hand corner. So Mining Store is in the business of managed mining. It's a full concierge white glove service from end to end. Clients like Cypherpunk only need to do two things. We need to pick the type of Bitcoin mining rigs we wish to deploy, and then we front the financing. Everything else, from acquiring the rigs, installation, site deployment, are all done by the provider on our behalf. And we certainly pay for that convenience. We take a clip on the hardware, we're charged the management fee, they take a cut on the revenue, and then they take another cut on the gross profit. So it's literally like falling through a tree and getting cuts and grazes from the branches all the way down. And in spite of all that drag, just based on these figures from November, we're able to walk away with a 36% annualized return. But also note that the 36% calculation has some fairly aggressive assumptions built into it in order to err on the side of caution. Notice that our machines were only operational for 18 days in November. That's a 40% downtime. And it's a once-off event, given that November was our go live month. And we were live 2/5 of the way in. I assumed in our monthly revenue going forward that those revenue run rates will be equal to 18 days of operation in November and not the full 30 days. And then I've also rounded down. So in fact, the projected profitability ought to be significantly higher than what we're seeing here. And after all that, to still end up with a 36% annualized yield for doing basically next to no work. Some of you may be looking at these figures and asking, well, should HODL be in Bitcoin or in Bitcoin mining? It's a fair question. If we are not ideology bound, if we are truly undogmatic, and we are dispassionately commercial, then that is a fair question. But it's also an open-ended question. Because the answer is, it depends. Bitcoin mining profitability is actually a function that depends on at least 16 different variables, 3 of which are the hash rate, the hash price, and of course the price of Bitcoin. And to make things more complex, some of these variables also depend on each other. For example, the hash price depends on the hash rate and the price of the underlying Bitcoin. And these variables are all random. They're stochastic processes. Mining actually provides clients with a profit calculator in Excel, but these values are all hard-coded. So from a risk management perspective, from a total cost of ownership perspective, you really can't use it. It's not that useful to us. So this holiday season, I will be developing models for our investment committee to provide a full scope analysis of what a self-encapsulated managed mining model would look like and what the expected yield would be under various scenarios so that we can stress test it. And then we can make an informed decision as to what extent we want to incorporate mining as a permanent facet to our range of operations in order to create value for shareholders. And just as a thought experiment out of interest, and I'll cover some of these details, some of these specifics in future sessions as well. You might then ask, if managed mining gets you 36% at the very least, well, how much can you make if you do it yourself? If you manage the whole thing, project manage the whole thing, or at least part of it? And again, that's a fair question. And it's, again, an open-ended question. The answer is it depends. The project management overlay, assuming we're able to develop those skills in-house, assuming that that is best use of our time, and it will certainly increase our operating leverage as well, which is detrimental because we have to start onboarding that expertise and maintaining certain assets and certain resources on our books. But in theory at least, it's a fairly linear project management effort. You purchase the mining rigs from an OEM. You purchase specifically built containers to house those rigs. You have to pay a subcontractor to install those rigs within those containers. You have those containers fitted with those rigs deployed to a suitable site, one with a low-cost energy source, preferably a renewable energy source. And then you pay a subcontractor to basically flip on the switch and then monitor the rigs on site to make sure that there's minimal downtime. So DIY mining is really a question of best use of our human capital. We need to understand what is the minimum incremental internal rate of return needed to justify this incremental body of work. Besides that, the risks are otherwise identical to that of managed mining because ultimately the end goal is the same. And last idea for the day, a number of deals we're pursuing on the blockchain front would require HODL to become a miner or otherwise provide access to mining as a service. Concurrently, we're exploring potential joint venture opportunities with oil and gas operations in North America to develop gas flare mitigation as an ESG compliant method for crypto mining. All these technologies are proven. Gas flare capping provides a source of energy that allows oil and gas operations to power a site off-grid without needing to connect to an external power source. What's more, flare mitigation as a service is an actual business model. And I've just included in the bottom left-hand corner a link to Crusoe Energy. That's an interesting case study for those who want to look at an operation that's currently operating in North America. So on that note, thank you all for listening. I will now take questions from the chat queue. Over to you, Veronica.